Yeah, I think clearly our message to our investors has been that unlike 2000, when all emerging markets behave like an homogeneous pack, life is going to be a lot more different this time. It's going to be heterogeneous. Whichever countries, whichever governments does the necessary things to kickstart growth, to do the necessary rebalancing, that economy would emerge stronger. And to your question on Ukraine, I think it's still a regional conflict. If we see Russia go to Crimea or go towards Kiev, and you see much serious repercussions in terms of economic sanctions, I think then is when you'll see all equity markets kind of get impacted, as crude may go up by about at least $10 to $15, because Russia accounts for 10% of global crude, 20% of global gas supplies. I think it's a fairly sensitive place because it's in Russia's backyard, and the last thing they want is, again, democracy to dominate, Western powers to dominate in Kiev. So I think it's always going to be a slightly sensitive issue. But what we saw from yesterday was Russia kind of a backing down, calling their forces back to the barracks. So I think that's some bit of a comforting sign. And I believe US has also moved in very quickly on this, saying that economic sanctions, political sanctions would come against Russia. So I think that eases the pressure for the time. I think what we've got to look at this emerging market outflows is that 3, 4 years back, global emerging market funds were in vogue. Everybody was putting money over there, and now people realize that again, some of the Latin economies may not do as well as Asian economies, which is why what you're seeing is broad outflows from EM funds. But what we believe is this leads to incoming kind of quarters is people taking a more nuanced approach, where you'll see some of the Asia funds getting money, some of the country funds like India post elections getting money. No, I think this is the time for private banks. Apart from private banks, what we've liked is also pharma and IT services, which we've been fairly vocal about. And I think this is a time where we're taking some money off our mid-cap IT names, some of the mid-cap pharma names, which have done exceptionally well and are pricing in a lot of good news. And we're moving this money to some of the private sector banks, which are trading at 10 times earnings. See, these are good businesses. Each businesses go through cycles, but I think they've weathered the worst of the cycles well, and somewhere valuations of 1.2 to about 2.5 times price to book, 10 time earnings for about a 15-20% growth in 2 years. I think it's a favorable risk reward. So private sector banks is a key overweight for us. We've been gradually adding a position over the last 1 or 2 months in that sector.